Welcome to a short 10-minute presentation on First In Financial. What is First In Financial and why was it started? First In Financial is a financial system based on my extensive research into the stock market over the last 7 years. Over that time, my personal expertise in AI programming and with a lot of help from my friends has taught me that it's important to know what you're talking about. Therefore, over that 7-year period, have registered as a financial advisor, have talked to many people in the industry, have become a knowledgeable person about different financial products and different options that are out there, such as the derivatives and other things. But at the base, this isn't about cryptocurrency. This is all about just picking those stocks. And the question is, can an AI pick those stocks better than a human, given that humans tend to lose money when they pick stocks themselves? And the answer is, of course, yes, but it can even do better than the market average, and it can even use the systems that Benjamin Graham wrote and that Warren Buffett uses better than the people who use it now. At least that's what the results have shown in terms of the gains over the last 7 years in live trading. So let me continue with this. That is the problem. Where is there this true value ETF? Where is there some fund that you can simply invest into and say, my investment is going to go into this simple system that picks the stocks that are more valuable than other stocks? Why is there still no funds that are dedicated to beating the market for everyone that actually do so? We need a solid, consistent, and automated fund out there that people can use to improve over market results. And many ideas have been tried over the years and have failed, or they just underperformed the market. Harvard and Yale had an endowment model that for 7 years beat the market and then 7 years afterwards failed to do so. Endowment funds, bonds, index funds, passive active investing, buying technical stocks only, cryptocurrency, it's all done very well for a short period of time and then failed. The value proposition here is that this investment system has a proven 7-year live trading real money track record of 20% internal rate of return, shows a low beta and relatively high alpha, which means that there's not as much risk and there's a greater reward. Our returns in the last year have been phenomenal at 128%. Don't want to talk too much about that because that might be down to luck, but in actuality, my understanding is that the stock market will drop every so often, and when it drops, the good stocks and the not so good stocks will drop both at the same time. So if you purchase the stocks that have a higher valuation, real valuation with real money and real investment that can repurchase their own shares, you're going to get a much better return in the short run. And that seems to be what's happened in the 1-year returns. Over the 3-year returns, it seems to match the returns that are expected over the long period of time, given my back tests, and that may be due to my investments being more consistent over the last few years. Over the 5-year period, the returns were matching this 26% return, which is still way better than anything most people can get just picking stocks. You'd have to do something very risky like purchasing options in order to get that kind of return somewhere else. So why is it that these other AI approaches fail? All these kinds of systems are out there. The magic formula is an AI filter that removes the fraud, bankruptcy, and bad data. In other words, as an AI programmer, it occurred to me that my expertise is in what AI can do and what it can't do. What it can do is read the numbers very well. What it can't do is tell you if those numbers are made up. So we have to go through and check those numbers first before we feed them into the system. And if somebody like Enron or Corinthian colleges or Radio Shack is just making up their numbers because they're going bankrupt or they're having some other issue, then you're going to get an issue where it'll look great to any system, any value system out there, be it low price over earnings or growth or momentum. You're going to get really great numbers, and your system will pick it, and it will be a wrong pick because those numbers are just made up. Another example are the Chinese companies from 2014. They crashed in 2017 and had to apologize to foreign investors because they were really just stealing foreign money by putting out whatever numbers they wanted in order to get as much investment as possible, when in actuality the companies that said that they were doing great weren't really doing as well. So the filter here takes any value system from unprofitable to profitable, because as long as you remove those stocks that are, in this case, either led by people lacking empathy and therefore they're more likely to lie and make things up in terms of the earnings, or perhaps they're going bankrupt, or perhaps they have bad data in their data stream. Whatever it is, this filter is partially manual, and it has to be manual because computers can't really detect empathy right now, but they can help. This system has been in place in some form or another for the last 6 years, but in the last year we've really formalized it, and that took our profitability from good to great. So we want to improve index funds, low price over earnings, and the magic formula kind of stock picking systems. This system will take those systems from unprofitable to profitable. If you try to run them without something like this kind of noise filter, then you're going to run into the issue where people will lie about their results in order to get picked by your system, and the more money you put into the market this way, the more scammers you're going to run into. It's a real issue. So the business model here is we want to take an equal investment in 20 to 40 stocks to limit our risk. We want to monitor for bankruptcy and fraud and sell immediately if we have that come up. And then every 3 months we drop the bottom stocks and buy the new top ones. This way we're holding on to stocks for many years at a time, which allows them to grow with our investment. And that can lead to a sustainable return over the long term. A competitive analysis here is very important. What we see here is that there's a good area where you have less risk and higher returns. But there's no real stock system that's really here. If you do a standard 60-40 asset, as many financial advisors will tell you to do so, you'll get a decent return and a decent risk. And that's why they tell you to do so. They're correct to tell you to do so. If you are just buying an index fund and some bonds, you're going to do okay with your retirement. This is a system meant to beat that, but it's also meant to acknowledge the reality that you're going to want to have some kind of backup for when the market does crash. The Standard and Poor index here has got very good returns. The real estate is a little riskier than the regular Standard and Poor index. The opportunity here is to improve your returns. This is where First In Financial stands, and this is where those Standard & Poor and those real estate investment trusts and that Standard 60/40 now sit. We've even moved the line up because it just seems that First In Financial just blows it all away in terms of risk versus reward. This automated strategy can really beat those systems that are out there, and it balances the risk and reward just as well as any other system out there, but it's so high on the list that even if you mixed it with bonds, you'd still not have too much risk and you would still get great rewards. So the management team is mostly myself, my CMU AI training as an enterprise architect and financial advisor, registered financial advisor with the state of Pennsylvania. You can trust me to care about your investment returns. Of course, past results don't guarantee future returns. So thank you to my collaborators from Google, from Carnegie Mellon University, from FedEx, and from the University of Berkeley for helping me with the new deep learning algorithms that are used in the empathy filter and the neural nets that were used in the original algorithms. The financial projections and key metrics here, what you'll see is the gains. So this blue line is how much the investments has gained. It's almost a 5 times gain, started at 100,000, almost up to 500,000 by the end of this graph. And the red line is just the Standard & Poor algorithm. If you just did an index fund based on the Standard & Poor or based on NASDAQ, you'll get decent results, and would definitely recommend that if you're not using a system like mine. But if you are going to use a system like mine, you can get much better results over the long term. The current status and accomplishments to date: we have a software as a service that's been created where we showed the stocks 130% gains since November 2020. We've had numerous empathy filters built in and tested out to make sure that they would work and added in, and the results have been spectacular. In November of 2020, we sent out those stock pick emails, and we've been sending them out since to a limited number of people. In May of 2021, we had a new Enterprise Forum video presentation. In July 2021, we had a stock info software as a service, and we have that available if you want to see it. We also have a Monte Carlo simulation as well. In fact, perhaps it'd be best to bring that up. So this is what that Monte Carlo simulation looks like. You can see that this is doing 1,000 runs. You could do 100,000 runs if you have a fast computer like mine. And the number of periods here is 12. This is using the live data. If you use the 45-year of backtest data, you'll see different results. And this is how much percent chance you have of losing money, of gaining money, of having a small gain of money, of having a medium gain of money, and so on and so forth. So in this case, if the results match the 45-year backtest of the Standard & Poor that were selected using my algorithm, you would have a 10% chance of losing over this 3-year period. That's 12 3-month periods. And you would have a 38% chance of gaining more than 100% returns, and a 26% chance of gaining 50 to 100% returns. So that just gives you some idea, given this Monte Carlo simulation, of how things could play out. And the way this works is it takes a bunch of months of returns, 3-month period of returns, and it randomizes it and says, okay, in the next 3 months you're going to get a random selection of periods of gains or losses, such as the data shows, and this is how well you'll do in some random future scenario. Alright, that is it for my presentation. Thank you for watching and listening. Stay safe.